The Dow Jones Industrial Average is one of the oldest indexes in the United States. Created by Charles Dow in 1896, it's composed of 30 blue chip stocks and price weighted as opposed to market cap weighted. To gain exposure to the Dow Jones Industrial Average, you can actually use an ETF. It's called the SPDR Dow Jones Industrial Average ETF Trust. Now, State Street Global Advisors actually are the ones who run these SPDR ETFs. There's $3.48 trillion in assets under management inside these different SPDR ETFs. And so what's interesting is SPY, SPY, the ticker SPY, the S&P 500 ETF that a lot of people know about. Guess what owns that ETF? Well, it's the SPDR Fund. So its name is the SPDR S&P 500 ETF Trust. So in case you haven't put two and two together before, DIA and SPY are owned by the same SPDR different funds. So they're the same fund company. Now we're also going to compare these with VOO, which is the Vanguard 500 Index Fund ETF. Now this is just like SPY, it tracks the S&P 500, but it's via Vanguard, so it's a different fund company. Let's compare these ETFs, VOO, SPY, DIA. The first thing we're going to do, and I've done this in some videos before, in case you've seen this, I can go over it quickly. So basically, SPY, VOO. They're two ETFs that track the S&P 500. They do the exact same thing. Why would you go with one over the other? SPY, for example, charges you 0.0945% to invest with them. However, VOO only charges you 0.03%. Why would you pay more money to go with SPY than VOO? What does it do? Does it do something special that would make you want to pay more money when you can go into any brokerage app, any place that you go buy stocks, and you could just buy a cheaper one for less money? Why would you do it is what I'm trying to say. And basically, there's only one reason. When we look at the spread between VOO and SPY, basically what's happening is you're going to lose a little bit of money between the bid and the ask prices of these ETFs. Why is that? Because one has more volume essentially than the other. So 4 cents over here is the bid ask between SPY and 9 cents is the bid ask between VOO. When I say more volume, basically we're talking about more liquidity, for example. And so, for example, today's volume for SPY was 73 million shares, but VOO, 3.4 million shares. So basically a lot more average volume is being traded within SPY than within VOO. So essentially, it's more liquid. Because it's more liquid, there's more demand, there's more people trading it. That's why SPY gets a better bid-ask spread, and it costs a little bit less money in that spread. But then on the other hand, it costs you more money in the expense ratio, right? So what you're doing is you're weighing the two. If you're trading stocks all the time, if you have a lot of money, it makes sense to go with SPY probably. But if you don't, then you just go with VOO. It's probably going to be better and more cheap for you over time. On to now DIA. How much does DIA charge you? So the net expense ratio is 0.16%. So 0.16 for DIA, 0.0945 for SPY, 0.03 for VOO. VOO is the cheapest of all of these, then SPY, then DIA. So DIA is actually going to cost you more money than the other ones. Now the total assets under management, the largest of these is actually VOO. It's got $753 billion in assets under management. It's a huge, huge ETF. SPY is also a very huge ETF, $358 billion. Then we have DIA with $27 billion. So a much smaller ETF, however, $27 billion is still a very large ETF. Let's talk about yield. I know a lot of you love dividends, you love distributions, you love to get some yield for your investments right now, especially because of what's going on in the market. Well, if we look at the 30-day yield, so this is the shorter term yield, what people are getting, 1.93 for DIA, SPY 1.49, and VOO 1.57. So you know what? DIA gives you more yield. And another interesting thing for some of those people who are, let's say, in the FIRE movement, financial independence, retire early, maybe you're already retired, you're getting close to retiring, well, this is going to pay you monthly. So if you do want that monthly income for whatever reason, DIA is going to give that to you, and SPY and VOO are not going to give you monthly income. Something to weigh for people. You might be someone who really wants that a lot, and for that person, this may be better for you to go with DIA. Of course, depending if you like the ETF, what it invests in, and what it does, but monthly income, it can be very powerful for a lot of people. So here's the thing with DIA and SPY in terms of how they go ahead and find which stocks are going to go into these ETFs. Let's go over the stocks first, and then let's figure out the methodology they use to actually go out and get these stocks. So in DIA, there's 30 companies, and SPY and VOO, there's 500 companies, right? The S&P 500, there's 500 companies, DIA is 30. So DIA has United Healthcare as its number one, and it's 11% of the portfolio. So it's pretty highly weighted in this one stock. And then it drops off down to 6% for Goldman Sachs, and Home Depot at a little bit over 5%. McDonald's, Microsoft, Amgen, Visa, Caterpillar, Honeywell International, Johnson & Johnson. Then we go up. These are the top 10 holdings, right? Then we go to SPY. We have Apple, okay? Apple is 7% of the S&P 500. That's why it's number one here. Microsoft, Amazon, Tesla, Google. There's two share classes of Google, by the way. So you have, let's say, just like a 3-ish% in Google. Then you have Berkshire, you got United Health, you have Johnson & Johnson, then you have XOM or Exxon. All right, how do you get to these stocks? Well, the S&P 500 is easy. So they take the largest companies inside the entire stock market. So the S&P 500, Apple is number one. Apple's the biggest company inside the stock market right now, and it's based on market cap. And essentially that means if you go and you bought all of Apple's stock, how much would it cost you? Well, it would cost you, I don't know, let's look real quick. So it would cost you only $2.48 trillion, right? Not too much, just like more than the GDP of most countries. So that's how much it would cost you to buy this whole company on the stock market. That's its market cap. So the S&P 500, it takes all the market caps, and the largest ones are weighted the most, right? So Apple is the highest market cap, then Microsoft, then Amazon, and down. That's how it gets the weightings of what goes on into its portfolios. Dow is different. The Dow does not use market cap, it uses price. This is why it's kind of like a little bit of an antiquated system and not necessarily probably the best thing to use. However, it's been around so long, it's got a great track record. There's a lot of history behind it, at least. And you can see the methodology they use here to figure out what stocks go in here. So while stock selection is not governed by quantitative rules. So unlike the S&P 500, which is quantitative, it goes and finds the biggest market cap companies and then goes down from there, 500, right? This only looks for companies that have excellent reputations, demonstrate sustainable growth, and is of interest to a large number of investors. The index committee monitors whether the highest priced stock in the index has a price more than 10 times that of the lowest. And then maintaining adequate sector representation within the index is also a consideration. So they want a range of different sectors, so they don't want all their money in tech, for example. And so let's take a look what the different sectors are. So for the Dow, the sector that's most represented inside the Dow is the healthcare sector, 21.1%, then information technology, 20.5%. Now the S&P 500 is inverted from that. So you got 27% in tech, then you have the next best one, which is healthcare, which is 14.1%. So they have the same top two, but they're interchanged. One's got healthcare and one's got tech. You're also gonna get a little bit more in financials inside of the Dow. And in terms of market cap sizing, so giant caps, the Dow is 57%, and then large, 42%, SPY, 48%, then 35.5%, and 15% mid cap, because remember, there's more companies inside the S&P 500, so you're going to get those smaller companies than in the Dow probably. So how does SPY do versus the S&P 500? Well, you might be a little bit surprised about this, and I'm using SPY in this and not VOO because SPY goes back further. We're showing going back to December 31st of 1998, so it goes back pretty far for both of these ETFs. If you had invested $100,000 into DIA, the Dow Jones Industrial Average ETF, you'd have $576,000 right now. That's 7.68% return. If you had invested in SPY, the S&P 500 ETF, $100,000 was $490,000. So that's only a 6.95% return annually. And interestingly enough, you have a higher standard deviation, meaning there's more risk essentially inside of the SPY ETF, which not a lot more risk, but a little bit more risk than the 14.67% in the Dow ETF. The max drawdown was going to be during the Great Financial Crisis, which was down 47%. So it was definitely, you lost a lot of money in both of these from that peak to the trough. S&P 500 down 50.8%. So you didn't lose as much inside the Dow ETF. But of course, you basically lost a ton of money if you had sold, of course. If you held it, you wouldn't have lost the money. You have continued to go get a gain of 7.68% for the Dow, 6.95% for a SPDR ETF. In terms of annual returns, well, DIA, of course, outperforms some years. SPY outperforms in other years. Here's what it looks like. Whenever the blue is up above the red, it means that SPY underperformed DIA. When it's down, of course, if the blue bar is not down as far, then DIA did better than SPY because SPY lost more money. Now what you're going to see here is kind of towards this last 10 years of time period here, you're going to see a better performance probably for SPY. The red bar is doing better here, so SPY outperformed, SPY outperformed, SPY outperformed, Dow outperformed in 2016, Dow in 2017, SPY was down more in 2018, and then it outperformed SPY 2019 it outperformed, 2020 it outperformed, 2021 it outperformed. Now it's down more than the Dow. In fact, if we actually change this, let's go back to 2010 instead of going all the way back to 1999. So if we look here from 2010 until today, we see a different picture. The Dow Jones Industrial Average DIA, $100,000 grows to $403,000, but the SPY ETF, $100,000 grows to $450,000, so it's a better return. Compounded annually, DIA 11.64, SPY with 12.62. So you're getting more growth for the SPDR SPY fund than DIA. So this of course leads us to the question, going forward, which one of these is going to do better over, let's say, the next 10 years? So to answer this question, I will tell you, I have no idea. I don't know which one's going to do better over time. So how do we decide which one is better ETF? Well, you could go with an expense ratio, go for the lower expense ratio. VOO would be the one that has a lower expense ratio between DIA, SPY, and VOO. Or maybe you want a little bit more yield, in which case DIA 1.93% versus SPY, VOO, and the 1.5-ish%. You get monthly payments for DIA versus SPY quarterly. So at the end of the day, what do I think is going to happen? I think over a very long-term period of time, 20 years let's say, I think the S&P 500 will do better than the Dow. In the short term, honestly I have no idea. I do think the Dow Jones Industrial Average is probably going to lose a little bit less money in a recessionary period than the S&P 500, but I have no idea if that is actually going to happen. That's what I think would happen. So I don't know the answer to this. If I had to choose one of these, I would go with the S&P 500 because I would want a larger cross-section of the United States' stock market, essentially, right? So I want more exposure to more companies, more diversification, I guess, than the Dow, which is only 30 companies, which are much larger than some of the other mixed companies inside the S&P 500. That's what I would do. It doesn't mean it's right, you know? It doesn't mean that SPY is going to do better than Dow. It's just my opinion, what I think for myself, and what I think might be better for me personally. So I don't really care about having monthly distributions. I don't care about the dividend yield being a little bit higher in one of them than the other. I care more about the growth. So that would be my answer for myself. Your answer for yourself, I hope I laid out all the potential things that could happen in this, and you can make a decision for yourself. So that's all I have for this video. Thanks so much for watching. If you liked it, hey, hit that like button. I would totally appreciate that, and subscribe. I appreciate that just as much. And I got another video coming up on the end screen. Please watch it right now. Thanks everyone so much for watching. I do want to remind you, I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please, do your own due diligence.